Welcome back to the Deep Dive. We're here to give you that strategic edge, breaking down complex topics. And today, we're diving into a project making some very bold claims, AIFEEX, or AFX. They're positioning themselves as building, well, nothing less than an artificial general intelligence foundation for a whole new financial ecosystem, aiming to democratize wealth management.
That's definitely the headline, yeah.
Oh.
But for, serious global investors, the kind we call smart money, hype doesn't cut it. What matters is the underlying structure, the tech, the competitive advantage. So our mission today is really to put AIFEX under a strategic microscope. Is this genuinely pioneering AGI or just very cluttered branding? We've got their technical white paper detailing the AGI architecture and also market analysis looking at the AFX token, its current dynamics, and some potentially huge catalysts coming up.
Right. So we're looking at the why behind the tech and the how behind the potential valuation.
Right.
The engineering and the economics.
Exactly. We need to see if there's a solid economic engine here that convinces smart money this is sustainable infrastructure, not just another flash in the pan.
Okay, let's start at the beginning then. The foundation. Why AGI? Wouldn't a really powerful, but maybe more standard AI algorithm be enough for managing wealth?
That's really the core distinction they're making. It's the difference between their vision and what's currently out there. See, traditional financial algorithms, even sophisticated AI, they're usually specialists, built for one job, right? Like optimizing a stock portfolio or finding arbitrage opportunities. They run on fixed rules. AIFEX's vision is different. It's this AGI-based federated financial ecosystem. The idea is the AGI acts like a central wealth conductor. We're talking autonomous agents, collaborating, learning constantly, watching global markets 24/7. It's supposed to be a leap from just automation to genuine financial cognition.
Okay, but artificial general intelligence, that's a massive claim, especially, in the crypto world where terms like that get thrown around a lot. What's the actual component here? What makes it general and not just, say, a very complex, specialized AI?
Yeah, fair question. The key piece they point to is Takwin. That's their proprietary financial large language model. Think of Takwin as the essential nervous system for this AGI. It's not one single giant AI brain, but more like a dynamic control center. It manages as a whole federated network of specialized AI modules. They actually call them financial organs. And these organs handle very specific complex tasks. Things like pulling specialized data from Swift messages or auditing DeFi smart contracts on the fly.
Okay, so Takwin is the conductor telling all the different parts of the orchestra what to play. Can you give an example of how this architecture gives them an edge in like a real-time market situation?
Sure. The real power comes from its ability to switch context instantly. Let's say there's a sudden market crash, volatility spikes like crazy. Takwin isn't supposed to just freeze or follow old rules. It's designed to switch modes, literally in milliseconds. It might swap out its high-frequency trading organs for deep, more risk-averse wealth management ones. The white paper kind of describes it as like Lego for decision-making, constantly rebuilding the best strategy based on what the market's doing right now.
That dynamic ability, that context switching, that definitely sounds like an advantage. But let's talk numbers. The white paper makes some pretty bold claims about performance compared to human strategies. These numbers, they're based on backtesting, I assume. And how does the source material address the execution risk, actually hitting those AGI targets in the real world?
Right. The data is primarily from extensive backtesting and simulations, yes. And you always have to add that caveat, real-world performance can differ. But the projected advantages they show are significant. We're talking 150% to 400% increase in total return compared to human-managed strategies in their tests. But maybe the most striking number, especially for long-term strategic thinking, is about consistency. The repeatability of successful decisions, their ability to replicate good outcomes, reportedly increases by 5,200% over human traders, 5,200%. That's the metric that points towards the system's potential for sustained, systematic learning and efficiency. And they also mention an 80% improvement in risk control capability.
Wow. Okay, consistency 52 times better than a human. I mean, that really is the definition of potentially disruptive infrastructure. So if the AGI, Takwin, is the brain, what does it actually do? What value streams does this intelligence capture? Let's get into that 7-module ecosystem.
Yeah, this is key to their strategy. AIFEX seems to understand they can't just be a single product. To succeed long-term, especially in finance, you need to capture value across the board, both CeFi, centralized finance, and DeFi. So this suite of 7 core modules, all running on Tokwen, acts like a diversified engine. It spreads the risk and aims to create multiple continuous revenue streams.
Okay, let's focus on the ones that seem most technically distinct or potentially profitable. How about the AI high-frequency quantitative trading module first? I mean,
Yeah.
HFT isn't new. What makes the AIEX version stand out strategically?
It's about bringing institutional-grade capabilities, potentially, to a wider audience. It operates across, reportedly, over 200 trading platforms, handling more than 5,000 trading pairs. And it uses pretty advanced deep learning models, things like LSTMs, transformers, GNNs, specifically for making predictive adjustments to portfolios in real time, alongside very sophisticated risk management. The projected yields mentioned are, frankly, extremely high, 365% to 800% ATY range, which suggests it's designed to capture tiny, fleeting opportunities that humans just can't see or act on fast enough.
And their next big move looks even more ambitious, maybe disruptive to existing players, the AI CEX, a next-gen centralized exchange planned for Q3 2025. What's the main problem with current exchanges that this AI CEX is engineered to solve?
The current CEX model, let's be honest, often feels slow, kind of opaque, right? There are trust issues, the whole black box problem. AIFEX seems to be attacking the major pain points for both projects wanting to list and for traders. For projects, they're proposing an AI token listing engine. It uses 24/7 automated scoring, looking at code quality, social sentiment, and things like that, aiming to slash listing times. From the usual, 4-6 weeks down to potentially just click to list.
That would certainly be a huge draw for new projects,
Mhm.
potentially driving a lot of volume to their exchange. What about for the traders themselves, the performance aspect?
Speed. It always comes down to speed in trading. The AICEX claims it will have a microsecond level matching engine. They're talking about reducing latency from the typical 5 to 20 milliseconds down to just 20 to 80 microseconds.
Wow.
Yeah, that's an exponential jump. It could fundamentally change things like slippage during high volume events. It aims to put the exchange on par with or even ahead of the fastest proprietary trading firms.
Okay, and the third key one, the AI DeFi aggregator. Now, for a lot of people listening, the big risk in DeFi yield farming is impermanent loss, right? IL. That penalty you pay if prices move while you're providing liquidity. How does the AGI here specifically tackle that problem?
That seems to be its main selling point, the core differentiator for the aggregator. Yes, it's designed for automated yield generation, scanning, as you said, over 1,000 liquidity pools every second. But the intelligence part is focused on risk management. It apparently uses GNN analysis, that's graph neural networks, pretty sophisticated stuff to try and predict price movements across different pools. And based on that, it dynamically shifts capital to protect against IL. The goal, they state, is reducing that impermanent loss down to less than 3%.
And it also customizes the strategy for the user's risk tolerance. Conservative, balanced, aggressive, that sort of thing.
Exactly. It optimizes the Sharpe ratio for the user. The Sharpe ratio is basically a measure of return versus risk, getting the most bang for your risk buck, so to speak. The system adjusts its approach based on how much risk you're comfortable with, aiming to make that kind of high-level risk management easy and accessible.
Okay, so we've got the AGI brain, Tokwen. We've got the infrastructure pieces like the quant fund, the AI CEX, the aggregator. We see the potential revenue streams. Now, if the tech is the engine, the tokenomics have to be the fuel, right? Let's get into segment 3. How does all this potentially translate into value for people holding the AFX token?
Right. Tokenomics are critical. AIBSX uses a dual token system, which is pretty common, designed for stability and utility. First, there's USDAI. That's their algorithmic stablecoin pegged to the US dollar. Importantly, it's designed to be heavily over-collateralized, like 200% to 300%, with assets including AFX itself, ETH liquid staking derivatives, and even real-world assets, RWAs. And this whole pegging and liquidation process is managed by an AI oracle aiming for dynamic stability.
Okay, so USDAI is the stable element. Where does AFX, the main token, fit into this picture strategically?
AFX is the utility token. You use it for governance, for staking, for accessing platform features. But crucially, it also acts as the ultimate risk backstop for the entire platform. If the system comes under severe stress, if the collateral for USDAI isn't enough for some reason, AFX is designed to be the last resort liquidator. This directly ties the value and utility of AFX to the overall health and solvency of the entire AIFEX ecosystem. It's not just speculative.
That link between the token and the platform stability is interesting. But let's talk about scarcity. The materials really emphasize supply reduction. It sounds aggressive.
It is aggressive and seemingly by design. It looks like a core part of the value proposition. They have this mechanism. Permanent buyback and burn. A significant portion of the profits generated from all 7 of those ecosystem modules. The white paper specifically mentions 50% of the profit fee from the AI Quant Fund, for example, is automatically used to buy AFX tokens off the open market. And then those tokens are permanently destroyed, burned, removed from circulation forever.
So that creates constant automated buying pressure and a continuously shrinking supply. What's the actual target rate for this shrinkage?
The stated goal is pretty remarkable, a projected net annual supply shrinkage of 36.9%, or potentially even higher. Their long-term target is to reduce the circulating supply down to just 21 million tokens within 5 years. This kind of structural program scarcity built into the core economics is definitely a major factor designed to attract and reward long-term holders.
Okay, that supply crunch is clearly the long-term investment thesis. But we have to address the here and now. Let's pivot to the immediate situation, the current market, because right now the price of AFX is, well, it's low. The sources we looked at cited it somewhere between 58 and 71 cents. What's the strategic read on that?
Yeah, this is where understanding the mechanics is absolutely crucial from a strategic standpoint. It looks like a classic case of temporary supply overwhelming demand, but for a very specific mechanical reason. The current low price, according to the analysis, doesn't really reflect the underlying tech potential or the long-term tokenomics. It seems to be almost entirely due to a short-term calculated supply release, the 100-day token unlock cycle that started after their AI DeFi upgrade went live. The scheduled release is basically flooding the market temporarily, creating daily selling pressure that's keeping the price down. It's a distribution phase.
Got it. So the price is more about this temporary token distribution mechanic than a reflection of fundamental value right now. What's the timing then? What's the strategic catalyst or catalysts that could break this suppression and maybe kick off the next phase?
This is where the timing gets really interesting. It looks like a potential convergence of 2 major events setting up what the analysis calls a perfect setup. First, simply the end of that 100-day unlock cycle. That removes the artificial daily sell pressure. The bleeding stops, so to speak. Second, and arguably much more significant, is the planned global exposure. This comes from listing on major centralized exchanges and, critically, the launch of their own AI CEX, targeted for Q3 2025. That CEX launch, if successful and on time, could open the floodgates. It means global liquidity, making AFX potentially as easy to buy as Bitcoin or Ethereum for mainstream investors, and it provides massive credibility.
Right, that combination, the artificial supply pressure ending just as massive global accessibility and demand potentially opens up, that definitely sounds like a strategic inflection point. And this brings us to investor psychology. The market analysis we saw talks about the current phase as the disbelief stage.
Absolutely. It's a classic pattern. The market is testing conviction right now. If you look back at crypto history, think about people holding Bitcoin when it was under $100 and crashing hard, or Solana when it was under $1. Fear, uncertainty, and doubt, FUD. It often blinds people to the opportunity right before a major potential shift. That lowest point, the stage where most people are skeptical or fearful, that disbelief stage, historically, that's often where the foundation for the biggest gains is laid. Patience during these periods of structural pressure can be key.
So the long-term vision, those hypothetical price targets mentioned in the analysis, like $10, even $100, that's all predicated on investors understanding the mechanics and having the conviction to hold through this current test.
That seems to be the strategic challenge, yes. The current low price acts almost like a filter. It separates those who perhaps understand the fundamentals, the AGI engine, the aggressive burn mechanism, the upcoming CEX catalyst, from those who are just reacting to the day-to-day price chart. And of course, we have to stress the execution risk. They must deliver that AI CEX launch effectively and on schedule in Q3 2025. That's critical. But if they execute on their roadmap, the argument is that the structural framework for significant potential value growth is already being put in place.
It definitely seems clear AIFEEX isn't just trying to launch another crypto token. They're aiming to build actual financial infrastructure driven by AGI like Tokwin, with core components like the AI CEX and the aggregator, and it's all backed by Tokenomics, specifically engineered for long-term scarcity.
Exactly, and you can see the scope of their ambition and how they seem to be approaching the bigger picture, too. This isn't just a niche DeFi play. They appear to be aiming for integration into mainstream global finance. The source materials mention efforts towards regulatory compliance, like FinCEN and MSB registration in the U.S., potentially seeking alignment with SEC frameworks down the line. They're playing a long game, aiming for global scale. Evidence like planned multi-million-dollar advertising campaigns, airports, high-speed rail suggests a well-funded, serious entity trying to build something substantial.
So we've essentially seen the blueprint for what they call Wall Street for everyone, a 24/7 potentially high-yielding financial system powered by a self-evolving AGI. History often shows that groundbreaking tech rewards early conviction. So the real question for you, listening as a strategic thinker, might be this. With this temporary supply pressure apparently set to end, and potential global liquidity on the horizon, will you position yourself as someone who understood the mechanics during the test, or potentially find yourself chasing the momentum later if things play out as they hope? Something to think about until our next deep dive.